Hey there, welcome back to the channel. Today, we're talking about a number that can make or break your chances of getting a loan, buying a house, or even financing your dream car. It's called your debt-to-income ratio, or DTI. Now, maybe you check your numbers and thought, oh no, my DTI is way too high. Don't panic. That's exactly why you're here. In this video, we'll dive into powerful strategies to lower your DTI. And yes, I'll share some real-life stories so you can see how everyday people turn their financial lives around. So grab a notebook, because by the end of this video, you'll have a clear action plan to improve your DTI and your financial health. Part 1. Understanding the problem. First, let's quickly review what a high DTI means. Backhand index pointing, right? If you make $4,000 a month and your debt payments, credit cards, loans, mortgage add up to $2,000, your DTI is 50%. That's pretty high. Lenders usually like to see below 36%, with 20 to 30% being the sweet spot. But here's the good news. Unlike your height or eye color, your DTI isn't fixed. You can improve it. And you can do it with strategies that are simple but powerful. Let me introduce you to Maria's story. Maria was a teacher making $3,500 per month. But her credit card, car loan, and student loan added up to $1,800 in monthly payments. That's a 51% DTI. She felt stuck, but she decided to make small changes. And in just a year, her DTI dropped below 35%. We'll get to how she did it in a moment. Part 2, Strategy 1, Decrease your debts. Let's talk about the most direct strategy, decreasing your debt. There are 2 proven ways. 1, the snowball method. Pay off your smallest debt first. Every time you knock one out, you gain momentum and confidence. 2, the avalanche method. Focus on the debt with the highest interest rate first. This saves you more money long term. Now, remember Maria? She chose the snowball method. Story segment. Maria had 3 credit cards and a car loan. Her smallest balance was a store credit card with just $500 left. She paid it off in 2 months. That victory gave her confidence. She then rolled that payment into her next smallest debt, a $1,200 card. Slowly but surely, she crushed them. By the time she got her student loan, her monthly payments had dropped by $400. That alone lowered her DTI. Here's a key takeaway. Every time you eliminate a debt, your DTI improves, not just because your balance goes down, but because your monthly required payment shrinks. And that's the number lenders actually care about. High voltage tips to make debt payoff easier. Cut unnecessary subscriptions, yes, even that streaming service you barely use. Automate your payments so you never miss one. Throw any extra money, bonuses, tax refunds, side gig income, straight at debt. Part 3, Strategy 2, Increase your income. Now, let's flip to the other side of the DTI equation, income. If lowering debts feels like climbing Everest, maybe the easier path is raising your income. Story segment. Meet John, an IT technician. His DTI was around 47%, and debt payoff alone wasn't cutting it. Instead of waiting years, he asked his boss for a raise. He showed the value he added, and guess what? He got a $300 per month bump. That alone improved his ratio. But John didn't stop there. He also started tutoring students in the evenings, making an extra $400 monthly. Within 6 months, his DTI dropped into the low 30s. Not because he paid off debt faster, but because he grew his income. Think about your own life. Could you ask for a raise or promotion? Start freelancing? Drive for ride-sharing apps? Selling used items online? It doesn't have to be permanent, just enough to shift your numbers in the right direction. High voltage tips to increase income. Learn one new skill that boosts your earning potential. Turn hobbies into income: photography, baking, tutoring. Negotiate better pay where you already work. Part 4, the magic combo. Now imagine combining both strategies, paying down debt and increasing income. That's where the magic happens. Mini story. A couple, Sarah and David, were planning to buy a home. Their DTI was at 49%. Sarah cut back on unnecessary shopping and used the Avalanche method to target their highest interest loan. Meanwhile, David picked up a weekend freelance job. In less than a year, they dropped to a 31% DTI and were approved for their dream home. Lowering your DTI isn't about perfection. It's about momentum. Even small wins compound into life-changing results. Part 5, action plan and takeaway. Here's your action plan. 1. Calculate your current DTI. 2. Decide, is it easier for you right now to focus on lowering debt, raising income, or both? 3. Pick one small step this week. Examples. Snowball your smallest debt. Ask your boss about a raise. Start a small side hustle. The key is starting today. Closing story. Back to Maria, our teacher. She didn't become debt-free overnight, but she picked one strategy, stuck with it, and watched her DTI drop month by month. When she finally applied for a mortgage, she was approved, and she cried happy tears. So, what's your Maria or John story going to be? The journey starts with one decision today. If this video helped you understand how to lower your DTI, hit that like button, subscribe for more money smart content, and share this with someone who's stressing about their debt. Remember, financial freedom isn't about luck. It's about strategy, and your strategy starts now. Thanks for watching. Don't forget to like, share, and subscribe.